In October 2008, a nation of 320,000 people, fewer than live in a mid-sized American suburb, watched its entire banking system evaporate in 9 days. Not one bank, 3 of them, simultaneously. The value of the national currency dropped by half before breakfast meetings could even be rescheduled. Grocery store shelves in Reykjavik started emptying because importers couldn't get foreign currency to pay for flour and fuel. A country famous for fishing boats and geothermal pools had, for one wild decade, tried to become a Wall Street on a volcano. And when it collapsed, ordinary Icelanders, teachers, plumbers, fishermen, woke up owing more on their mortgages than the day before, even though they hadn't borrowed a single new krona. This is the story of how a tiny island nation grew a banking sector 10 times larger than its entire economy, why nobody stopped it, and what happened when the bill came due. It matters because the same ingredients, cheap foreign money, financial deregulation, and bankers who believed their own hype, reappear in every credit bubble, from Iceland to Ireland to your own country's next housing headline. Understanding Iceland means understanding why "the bank told me it was safe" is never, by itself, a reason to believe something is safe. The story begins in the early 2000s, when Iceland's government privatized its 3 largest banks, Kaupthing, Glitnir, and Landsbanki. For decades, these had been sleepy, state-run lenders that mostly financed fishing boats. Once deregulated, they were handed to a small circle of ambitious businessmen, among them Björgólfur Thor Björgólfsson and retail tycoon Jon Ásgeir Jóhannesson, under a central bank led by former Prime Minister David Oddsson, who had championed the very deregulation now putting these banks in private hands. The bankers didn't want to stay small. They borrowed enormous sums of money from international lenders, far more than Iceland's economy could ever realistically back up, and used it to buy stakes in each other, in British retailers, in Danish banks, in anything glamorous. By 2007, the combined assets of these 3 banks were roughly 10 times the size of Iceland's entire GDP. Picture a single fisherman taking out a loan larger than his entire town's yearly income, and then using it to buy shares in the boat next door, which also took out a loan to buy shares in his boat. That circular, self-reinforcing ownership pumped up stock prices with money that wasn't really there. Here's the mechanism in plain terms. Banks make money mainly 2 ways: charging more interest on loans than they pay on deposits, and borrowing cheaply to invest in things that, hopefully, earn more. Icelandic banks borrowed in foreign currency, dollars, euros, pounds, because interest rates abroad were lower than at home. This is called a carry trade. Borrow cheap in one currency, invest for higher returns elsewhere, pocket the difference. It works beautifully until the currency you borrowed in gets more expensive relative to your own, at which point your debt balloons overnight, even though you didn't borrow a single extra cent. To fund even more lending, one of the banks, Landsbanki, launched an online savings product called IceSave, offering juicy interest rates directly to ordinary savers in Britain and the Netherlands. Hundreds of thousands of foreign depositors, lured by returns their local banks couldn't match, parked their savings in an Icelandic internet bank most of them had never heard of a year earlier. Deposit insurance, the promise that a government will reimburse you if your bank fails, existed on paper, but nobody had checked whether Iceland's tiny central bank could actually cover claims from an entire foreign country's worth of depositors if things went wrong. 3 structural failures made the collapse almost inevitable. First, Iceland's central bank was a lender of last resort only in krona. It could print unlimited krona to save a domestic bank, but it could not print dollars or pounds, and these banks owed the world in foreign currency. Second, regulators let cross-ownership run wild. When one company's stock fell, it dragged down the value of everything that owned shares in it, and everything that owned shares in that. Third, political and financial power sat with the same small circle of people, so nobody with real influence had an incentive to sound the alarm. When the 2008 global credit crunch hit, and international lenders stopped extending fresh loans to anyone that looked risky, Icelandic banks couldn't refinance their mountain of foreign debt. Kopting, Glitnir, and Landsbaki collapsed within days of each other in October 2008. The krona lost half its value. Inflation spiked past 18%. Ice savers in Britain and the Netherlands suddenly couldn't withdraw their money, triggering a diplomatic crisis that dragged on for years. The consequences were brutally real. Icelandic households, many of whom held mortgages indexed to inflation, watched their loan balances grow even as their home values fell. A bizarre inversion where paying your mortgage on time didn't stop you from owing more each month. Unemployment tripled. Capital controls locking money inside the country stayed in place for nearly 8 years. British and Dutch governments demanded Iceland repay billions to cover their citizens' Icesave losses. Icelanders, in a rare move, voted twice in national referendums to reject repaying that debt on the terms offered, arguing ordinary taxpayers shouldn't cover bankers' gambling losses. And in a twist almost unheard of anywhere else in the 2008 crisis, Iceland prosecuted its own bank executives. Kopting CEO Sigurður Einarsson and several other top bankers received real prison sentences for market manipulation and breach of fiduciary duty. While in most of the world, the architects of the 2008 crash walked away with bonuses intact. So what should you actually take from this? First, watch the ratio of a country's banking sector to its GDP. When banks grow far larger than the economy backing them, the government literally cannot bail them out in a crisis, no matter how badly it wants to. Second, a high interest rate on a savings account is a signal of risk, not generosity. Nobody pays you extra for free. Someone somewhere is taking on danger to fund that yield. Third, deposit insurance is only as strong as the government standing behind it. So know where your money actually lives, not just what interest rate it earns. Fourth, when the same small group of people run the banks, the businesses borrowing from them, and the regulations meant to police them all, treat every reassuring headline with real skepticism. Here's the reframe worth remembering. Iceland didn't fail because its people were reckless. It failed because a handful of insiders turned an entire nation into collateral for their own bet, and for once, some of them actually paid for it. If you found this useful, subscribe, hit like, and drop a comment telling me which economic story or concept you want explained next. Crisis, scandal, or idea, I'm building the list from your suggestions.